If you earn £30,000 a year and you have a rental property where the rent is £1,000 per month, if you own that property in your personal name, you made £240 per month. If you own that property in a limited company, you made £207 per month. Mathematically, in this situation, you're better off buying that property in your personal name as opposed to in a limited company. Let me explain why that works. So let's say the rent is £1,000, your mortgage payments are £500 a month, and your expenses are £200. Now this is your maintenance, management, insurances, all those sort of things. Pretty easy to work out what the profit in this situation is because you just do rent minus the mortgage minus the expense, which is essentially this section here. To work out the profit, 1,000 minus 500 minus 200, and therefore your profit in this case is £300 per month. This is what used to be the case. In 2016, they brought in a new tax change called Section 24. Section 24 basically stipulates that your mortgage interest of £500 can no longer be considered as a cost. So even though you only made £300 and you still have a cost of £500 of a mortgage, from a tax point of view, it's no longer a cost. So therefore, the government argues that your profit isn't £300, your profit is this area plus this area. So now your profit is all of this area, which is 300 plus 500, and therefore you have made £800 per month. Even though you haven't made £800 per month, you've only made 300. From a tax point of view, you've made 800. If you make £800 across the year, that's £9,600. So we need to work out how much tax would you pay on £9,600. So these are the income tax brackets in the UK as of right now. The first £12,750 you earn, you don't pay any tax because of your capital allowances. The difference between £12,500 and £50,270, on that portion you pay 20% tax. The difference between £50,000 and £150,000, on that portion you pay 40% tax. And any money you earn, which is more than £150,000, you pay 45% tax. We said in this example that your salary is £30,000. On your first £12,570, you didn't pay any tax, and the difference between £12,570 and £30,000, which is about £17,500, you're going to pay 20%. Now you made another £9,600 of income. So your overall income salary has now gone from £30,000 all the way to £39,600. But as you can see, you are still within the 20% tax bracket because your overall income hasn't gone beyond £50,000. The additional income you have made from that property, you have to pay a 20% tax. Because you made £9,600, but now you have to pay a 20% tax. That 20% tax comes to £1,920. However, there is one difference. Back in the day, you could consider your entire mortgage as a cost, which, like I said, you can no longer do. But there is a tax relief that 20% of your mortgage you can still consider as a cost. If your mortgage payments are £500 a month, well, 20% of that is £100 per month. Now across the year, that's £1,200 per month. Tax relief equals £1,200. In order to work out how much tax you would actually pay on this property is 1,920 minus 1,200, £720. Let's work out how much money you would actually make from this investment property. Your profit is only £300 a month. So if you made £300 a month, times that by 12 for the entire year, that comes to £3,600. But then you have to pay a tax of £720. The money you actually made is £2,880 across the year, which works out to be £240 per month. Now let's compare this to how much tax you would pay on the same property if that was bought in a limited company. So once again, your rent is £1,000, your mortgage payments are £500, and your expense is £200. You made a profit of £300. The only difference with a limited company is you can actually consider your mortgage cost as a legitimate cost, and so your profit is actually £300 as opposed to the £800 in a personal. With a limited company, you simply have to take your revenue minus the cost, take your profits, and then work out the tax. In this case, the revenue is £1,000 per month. Multiply that by 12. That's £12,000 a year. But then you have cost of 500 and 200, which is £700 per month. So 700 times 12 comes to £8,400. With the limited company, you're also going to have some accounting expenses. You might have an accountant, those sort of things. So now let's just say it cost you about £500 in terms of accounting expenses. Therefore, the company made a profit of £3,100. Let's say you take that £3,100 and you pay that to yourself as a salary. The company now technically hasn't made a profit because you've taken the entire thing out, and so there is no corporation tax. How much tax would you pay on the 3,100? If we go back to this, you originally had a salary of £30,000. You have made an additional income of £3,100, so therefore your salary now has gone up to £33,100. Since you're still within the 20% tax bracket, you just have to pay a 20% tax on the additional income that you have made on that property. If you pay a 20% tax, that's £620. If you made this much money but then had to pay this much tax, you're effectively left with £2,480 per year. That is £207 per month. So therefore, if you bought this property in a limited company, you made £270. If you bought this property in a personal name, you made £240 a month, which is more than how much money you would make in a limited company. So therefore, clearly in this situation, it's better to buy this property in a personal name as opposed to a limited company, even though there are so many tax benefits of buying properties in a limited company. If there are so many tax benefits in a limited company, and everyone keeps talking about the fact that it's so much better to buy in a limited company, but clearly in this example, that's not the case, in which case would it be better to buy a property in a limited company as opposed to a personal name? To work that out, we have to go back to this diagram here. If you think about it, what's happening is when you bought the property in your personal name, your income went up by £9,600. When you bought that property in a limited company, your income only went up by £3,100, which is significantly less. This is when it's going to be better for you to buy a property in a limited company. Let's say you had 2 investment properties. So now your income goes from £30,000 to £39,600. If you have 1 more property, your total income is now £39,600 plus another £9,600. Your total income comes to £49,200 when you have 2 properties. If you have 1 more property on top of this, your income once again is going up by £9,600. If you have £49,200 plus £9,600, now your income is £58,800. When you get to your 3rd property, you have now crossed the threshold of 40% income tax. Any money you have made between property number 2 and property number 3, which is in the threshold of 40%, on that income you have to pay 40% tax as opposed to 20% tax. If you're going to be buying a lot of investment properties, you're going to get into that higher tax threshold very, very quickly, despite whatever your base salary is. If we compare that to the limited company situation, well, you had 1 property and your income was $33,100. If you have 2 properties, this goes up by another $3,100. So your total salary has now gone up to $36,200. If you have 3 properties, your total salary is now $39,300. You're still way below the next tax threshold, which begins at £50,000, even with 3 properties. Whereas in the personal, you are way above the tax threshold the second you hit 3 properties. So if I go to this calculator, we have 2 properties and I press calculate, well, it still says that you're better off buying in your personal name. The second you get to 3 properties, what happens is now is better to buy in a limited company. If you own 3 properties in your personal name, you will be making £578. In a limited company, you will be making £687. And the reason for that is because the 3rd property has to pay 40% tax, whereas the first 2 didn't have to pay 40% tax. So to cut a long story short, if your salary and number of properties combined are within £50,000 and you're a basic rate taxpayer, you're probably going to be better off in a personal name. However, if your plan is to build a large property portfolio and you know that very quickly your salary plus the income from your properties is going to take you beyond that £50,000 threshold very, very quickly, you're going to be better off buying that investment property in a limited company as opposed to in a personal name. How much does it cost to set up a limited company? You can click this link here. You can set up a limited company for £12. The company Awesome, who's also the sponsor for this video, they'll set up your company, they'll set up your bank account, they will do everything. Now there is one caveat to this, which is if you look on the calculator that I've made, it says that in most cases, it will be better to buy in a limited company or a personal name. This is something we need to consider. Let's say you have an investment property, you bought it for £100,000. You have a 75% loan to value mortgage. So that means, put simply, you have a £75,000 loan. And let's just say this mortgage is with HSBC Bank, and this area here is your mortgage. 10 years down the line, this property doubles and now it's worth £200,000. You say to Barclays Bank, hey, come and value this property. They value it £200,000. And they say, yep, we'll give you a 75% mortgage on the new value of £200,000. You say to Barclays, yep, that makes sense. I'll take the 75% mortgage at £200,000, which is £150,000. So Barclays Bank gives you £150,000. You still owe HSBC their £75,000 from the original mortgage. Barclays gives you £150,000, you give £75,000 to HSBC, and therefore you are left with £75,000. If you own that property in your personal name, that £75,000 goes straight into your bank account. On that £75,000, you do not pay any tax whatsoever because that money is a loan and you do not pay tax on loans. You only pay tax on income. So therefore, in personal, your tax is 0%. If you own this property in a limited company, exactly the same thing happens, but that £75,000 ends up going to a limited company. Now it's sitting in your HSBC limited company bank account. If you want to take that money out, let's say you take it out as a salary and you are a high rate taxpayer, on that money, you're going to have to pay a 40% income tax. You're going to have to pay about £30,000 in tax just to get that money back out. And so therefore, that is one big benefit of buying a property in your personal name as opposed to a limited company, the fact that you can get the money tax-free. So that's why it's not as clear-cut. But the reason I think the calculator still makes sense, this calculator analyzes what makes more sense from a cash flow point of view, which in property investing or any type of investing is probably the most important thing, purely because it's all great saying, well, in 10 years time, I'm going to make £75,000. But if you're losing money on a monthly basis or you're making hardly any cash flow, then that's not really an ideal place to be in. Because the big problem with buying properties in your personal name is you could be in a situation where you're actually losing money on a monthly basis on investment properties. The rent is £1,000 a month. Your mortgage is £700, maybe the interest rates have gone up and your expenses are still the same at £200. Well, in this case, now your genuine income is 1,000 minus 700 minus 200, which is this area here, which is £100. You have made £100 multiplied by 12, which is £1,200 every year. However, from a tax point of view, you haven't made £100, you've actually made this entire section here. So therefore you have made 100 plus the 700, which is £800 a month. So £800 a month across 12 months comes to £9,600. And once again, you get a tax relief, which is 20% of the mortgage, which is, this section here. 20% of 700 comes to £140. So therefore, £140 multiplied by 12 for the entire year comes to £1,680. That is your tax relief. Sorry, I forgot to do one thing. The £9,600 you made as income, let's just say you have a few properties in your personal name and that pushes you into the high rate taxpayer. So now you're a 40% taxpayer. On that property, if you paid 40% in tax, that would be 9,600 times by 40%, which is £3,840 in tax. But like I said, you have a £1,680 tax relief. So what is your total tax bill? It's 3,840 minus 1,680. That comes out to £2,160 in tax. If you only made £100 a month, which is £1,200 a year, but now you're paying £2,160 in tax, that means you have lost £960 per year. When you see all these articles online like this one, is this the start of the great buy-to-let sell-off? And they all talk about how buy-to-let landlords are leaving the market because it's no longer profitable. If you scroll down on those articles and read closely, this is what it says. Based in London, he owns most of these homes through a limited company, but a significant number are held in his own name. Over the coming years, I intend to sell all the properties I own in my name. People are not selling the properties they own in a limited company because of the fact that you pay significantly less tax. They are selling the ones which they own in a personal name. So sometimes articles like this can be a bit misleading. So therefore you can use this calculator I made. The link is in the description below and you can put in the number of properties you want to aspire to get to and it will tell you whether you're better off buying in a limited company or in your personal name. So hopefully that clears up the debate because it really just depends on your situation and it's not as simple as everyone just buying in a limited company and people just preaching that that is the only way forward.